Today I give you 5 ways you can save on tax, but you must implement a lot of these things before the 30th of June. Hello everyone, my name is Ethan Rushock, and on today's video I'll be talking to you about 5 different ways you can save on tax, but these are methods that you need to implement before the 30th of June. So it's so important to get these things done before the 30th of June so you've got them locked and they're ready for your tax return. And look, it's a really common thing. Everyone wants to save on tax and they want to know methods they can do to save tax, but quite often they leave it too late, and by the time they go to their accountant, it's too late. There's not much the accountant can do at the time of the meeting because they're talking about a year that's already happened. So a lot of these decisions you need to make during the current financial year so you can claim it in that year's tax return. Now, speaking of things you should do before the 30th of June, you should definitely subscribe to this channel. It really helps me get my message out to more people. So hit that like button, hit that subscribe button, and leave a comment. It really helps me with the YouTube algorithm. Anyway, let's get back into the video. Alright, so the first thing that you can do before the 30th of June is a really simple one, and it's pay for any work-related expenses. So it's so important, if you've got something you know you need to buy for work that's going to be claimable, make sure you put that claim in. Make sure you make that deduction before the 30th of June. It's no good if you've got a license or a registration you need to pay for, or you've got to buy some work-related stationery, or you need to make a donation to charity. Make sure you do that before the 30th of June so you can claim it in that year. You're much better to do it in June rather than wait until July and then have over 12 months before you can claim that deduction for that expense. Now, this only applies to deductions under $300, so stay tuned for later on in the video where I talk about why the $300 mark is really important and why you might not want to rush those bigger purchases before the 30th of June. Alright, so the second tip is to check your super contributions, and if you're going to make an additional super contribution, make sure that is done well and truly before the 30th of June. So the first thing is, one, you've got to consider, is making a super contribution right for you? You can either do your own research or go to a financial planner and discuss that with them. This isn't something that quite often your accountant will be able to discuss with you, so keep that in mind. But you want to check is, are you going to breach the contribution cap for concessional contributions? So the cap is currently set at $25,000, so you want to make sure any additional contributions you're hoping to claim isn't going to breach it, and you've got to take into consideration how much your work might have already contributed on your behalf, because that'll likely count towards that cap. And you need to check with your super fund is, if you make a contribution on, say, the 20th of June, is that enough time for them to clear that before the 30th of June? And then you got to see what paperwork is required. So quite often there is a form that is really just a notice of intention to claim that you may have to send off to your fund to make sure that they record it correctly on their end. This is important to make sure that you're eligible to claim that as a deduction in your tax return. Now, before I get into tip number 3, if you like listening to podcasts and you want to learn more about tax or business or a bit about entrepreneurship, make sure you head over to wherever you get your podcasts. So if you head over to Spotify, you'll be able to find Tax Talk with Ethan Rushock, my new podcast. So in this, I talk about tax, accounting, business, entrepreneurship, and just anything personal finance. So make sure you head over to Spotify, hit that follow button, and give it a listen. Anyway, let's get back into the video. So the third thing is locating your receipts. And I know this sounds like a really basic one, but honestly, it's the biggest reason why people miss out on tax deductions is because they've lost their receipts, they can't remember the amounts, and therefore it's not included in their tax return. So do this well before the 30th of June so you're not running around on the day of your appointment with your accountant trying to find your receipts. It's quite common for clients to come to me and go, I couldn't find the receipts, I searched for them today, couldn't find them, therefore don't worry about including it. So do this legwork beforehand, organise your receipts. It doesn't matter how you do it. Keep them in a shoebox, keep them in a folder, keep them in some kind of online cloud storage. This is actually the method I use. I use my Google Drive, I scan or take photos of any receipts I have through the year, chuck them in there, and they're done and organised. The other option is that ATO have an app. You can literally log these as you go through an app. So again, another easy method you can do through the year, but make sure you're getting this stuff organised before the 30th of June so it's all ready, so you can get your tax return done straight away if you're wanting to get your refund back quicker, but you're also not trying to scramble on the day of an appointment trying to find stuff, and that's when you're likely to not find it and therefore not include it and miss out on a legitimate tax deduction. So the fourth one is having a logbook if you're using the logbook method. So you've got to make sure that your logbook is valid if you're using this method. So the logbook method obviously relates to car-related expenses, and it needs to be kept for a 12 continuous week period, and then that logbook is valid for 5 years. Now, if this is the first time that you've got that vehicle, then that logbook may run over 2 financial years. So for instance, if you do buy a new vehicle in June, you can keep that logbook for starting in June and run that for 12 weeks from then. But you really want to make sure that your logbook is valid if it's for an older car. So if it's outside of that 5-year period, you need to get that logbook done before the 30th of June so you know what you can claim for it. You don't want to put in a claim and then get an audit and the ATO go, oh, please produce your logbook, and it turns out that your logbook's out of date, and that's going to cause you big issues during an audit. And if you're considering the logbook method, make sure that you've kept all of your documentation you need for that. So you'll need your receipts for your fuel, for your registrations, for any repairs you've done on the car. So there's obviously a lot more record keeping if you choose the logbook method over the cents per kilometre method. And then the last tip is actually something maybe you might not want to do before 30th of June, is big purchases that are over $300 is understanding how they work when it comes to a tax deduction and why all the advertising you see on TV and in the media may not be correct. So as we're coming up to June, you'll see plenty of ads on TV, on social media from a lot of the big tech companies saying, quick, get your tax deduction before the 30th of June, buy a new computer is one of the biggest ones that they advertise. Get your work-related deduction. You'll see a lot of this, especially with a lot of people now working from home, is there'll be a big push from the advertising to upgrade your computer or buy this new computer chair and desk and home office setup, and they'll say, oh, you can claim the deduction, get it in before the 30th of June. But this isn't always true. Now, this only applies to individual taxpayers, not to those running a business. But for individual taxpayers, anything over $300 is likely going to be depreciated. So what that means, you're not getting an immediate deduction for that full amount in that year. So it's not negative in the long run because you will get to claim the deduction, but it's not going to be all in that year because the deduction starts from purchase date. What this means is that if you go and buy it on the 30th of June, well, you can claim that deduction. You're only getting 1 day because you've only got it for 1 day during that financial year. Now you'll get to claim the majority of potentially that asset in the next year, depending on what it is and how quickly it depreciates. So don't go rush out and buy a new computer for $2,000 on the 30th of June, expecting that you're going to get to claim it fully in that year and get the tax benefits straight away. And you'll see that because there's so much advertising pushing to that. I see clients quite often come in and go, oh yeah, but I bought this computer, and they've bought it sometime in June. And when I try and explain to them that, look, yes, you can claim it and it will be claimed over a number of years rather than all up front, they're a bit disappointed because they're expecting to get a much larger refund because they've spent that money, and it might be a legitimate tax deduction, but it's going to be depreciated, and therefore you're not going to see all those benefits straight away. So I hope those 5 tips have been helpful. As you can see, there's certain things that you need to do before 30th of June for it to be beneficial. So make sure you get things organised, do it before 30th June, leave yourself plenty of time up your sleeve if it's something like a super contribution, and hopefully it will maximise your tax return by having legitimate deductions at the right time and in the right method and with the right documentation. As you can see, it's all about getting things right. Alright, that wraps up today's video. Hit that like button, check out some of the other videos I've got on my channel for other tax tips, and I'll see you again next time.